name is Joan Rogliano. I've been a realtor for about 30 years, and I specialize in helping families who are going through divorce decide what to do with a marital home. I want to take a minute to talk about divorce, real estate, and taxes, because there can be capital gains taxes involved when someone retains the marital home. In a previous video, we spoke briefly about the 3 rules regarding capital gains and the sale of a property. The first is the exclusion rule, whether you are allowed to take a $500,000 exclusion or a $250,000 exclusion. And the 2 rules we're going to talk about now can determine whether you are allowed to take $250,000 or $500,000. The 2 rules we're talking about now are ownership and also use. So regarding the usage rule, that means that was the house used as your primary residence? It has to be in order to qualify for a capital gains exclusion. If you lived in the house for 2 of the last 5 years and it was your primary residence, you might be able to not have to pay capital gains tax. The second rule is that of ownership. Is the property in both parties' names, or, as frequently happens after a divorce, is the title now just in one person's name? Again, this goes back to the exclusion rule, because if the parties both own the house, they both have ownership, you're entitled to a $500,000 exclusion. And if, as usually happens, one party is now on title, then that drops down to a $250,000 exclusion. So remember the 3 rules. What's the exclusion? What's the ownership situation? And how was the property used? It's very, very important that everybody understand this before they decide to keep the marital home, because we certainly don't want them in a situation where they're facing a surprise somewhere down the road that they and they alone are responsible for a capital gains tax.